Hello, good morning. My name is Remon Vos here at CTP CEO, and we are here today to talk to you about the Q3 results for 2022. Thanks for joining. So far has been very positive, and we're going to talk to you together with Richard and Patrick later on about a bit more detail, but we are on schedule, and that is good when it comes to completing projects, but also when it comes to leasing the portfolio. We continue to be very active on the two activities, income producing part as well as the new build. Demand mostly deals with existing clients, bring business to Central Europe. Why? Business smart, low cost manufacturing, labor cost in Central Europe, 1/3 of what they are in Western European countries, with a motivated, hardworking workforce, and that is what clients have experienced, and that's the main reason for them to grow. How they grow, bringing more activity, as I explained, not just easy low-cost manufacturing, but also more value-add activities, point one. Point two, building inventory, taking more space because of the uncertainty of the supply chains, which we have seen. Point three, trend is nearshoring, friendshoring, bringing it to Europe for European markets, both Asian companies, but also European companies and American companies set up shop in Europe to support their business over here. Different industries, automotive, but also data center industry, electric bike industry, all type of different things. And later on, I will be talking about retailers, because we also see strong demand from fashion retailers and all other type of retailers, companies we've been working with whom we continue to extend our cooperation. And all of that is very positive for us in order to develop our land bank. Although, and of course, we will be very careful with the markets changing as they do, but so far we see significant opportunities. In numbers, the leasing dynamic so far, in the third quarter, we signed more than 570,000 square meters of leases. Few tenants, obviously Kuehne+Nagel, good tenant, logistics service provider, but also with Tesco, Lidl, and Hennes & Mauritz are among the largest deals we have been able to do. This results in more than 80 million euro of additional income. And that's almost double of what we've done during the first 6 months of 2022. This proves again, we continue to see strong demand. The leases which we have signed were a bit higher per square meter than what we expected, approximately 6.2% above our ERV. And that's pretty positive for the moment. If you add that 80 to what we already have secured in terms of rental income, and you look at the coming 12 months, then we plan to collect over the next 12 months a total of 566 million euro. Very little bad debt, as you know, very strong client base. And this, of course, is very positive for our cash flow. Strong long-term income for buildings completed. We see rental growth. Richard will talk about that more. Very positive, and financed, of course, at very attractive terms last year and before. I wanted to give you a short update on Poland. You remember we've done that deal earlier this year, buying 2.4 million square meters of land. We can build 1.2, and I can report to you that we have started multiple sites and locations, so we are underway with construction in Poland as well. Have a team of almost 50 people, projects in and around Warsaw, but also along the border with Germany, in Upper Silesia, and soon to start in Gdansk. So positive about Poland. Also, we see demand for our properties. That is also because we see less supply from other parties. Central Europe core business going very well.
Our portfolio will be approaching 11 million square meters by year end, and we are on track to reach our 20 million square meter target in the 2020s. In total, we've been able to realize strong like-for-like rental growth of 4.3% over the past year. We continue to create value with our highly profitable tenant-led development pipeline. We delivered 329,000 square meters in the third quarter, of which 96% is leased, with a yield on cost of 10.2%. While our overall slightly lower pre-letting is mainly attributable to our market entry strategy in Poland, where we started a number of speculative developments. However, we expect to reach our 80 to 90% pre-letting at delivery, consistent with our performance in previous years. In the third quarter, we continued full speed with our ambitious solar energy investment rollout. We're on track to reach capacity of 40 megawatt peak by year end and target to add an additional capacity of at least a further 100 megawatt peak over the course of 2023. And this with a yield on cost of at least 15%.
We're active in Holland, Germany and Austria. Strategic importance for us to have Western European markets combined with Central European markets. If I go to, for example, Austria as one of our Western European countries, very positive. We have a new country head, Matthias. I'm very excited of having him on board to run and grow the business. In the meantime, we have multiple projects under construction around Vienna, a total of more than 100,000 square meter lettable. And then we are looking at 10% yield on cost in Austria, a bit higher. The first Western European country. Second, the Netherlands. We are doing well on our project in Amsterdam, on schedule, in budget. Leasing-wise, there is a tenant who will likely going to move in soon. We are talking to a number of potential tenants and on schedule to fill that up by the first half of next year. The change legislation in Holland about bringing more property to the market help us there. And ALC, we see strong demand and very little supply and no vacancy in the Amsterdam market. That's Amsterdam. We have signed with the city of Waalwijk an agreement for cooperation for 40 hectares. And we've also signed an agreement with the city of Gorinchem to do a nice mixed-use development. Germany, of course, with the acquisition earlier this year of the Deutsche Industrie, come with approximately 90 buildings throughout Germany. In the meantime, we also have set up a team, office in Berlin, in Düsseldorf, and in Stuttgart to be on-site, hands-on, where the business happens. That's also where we plan to hit 10% yield on cost. How are we going to do that? Multiple things. Start first of all with increasing the rent. When we bought it, it was like 37 euro per square meter per year for rent. And we think we can increase that to around 50, maybe even 60 in some cases. And that's what we are seeing now. So we're doing deals at significantly higher levels than what we have seen or what the portfolio is leased at. So that's one. Second, we're going to build on land we bought together with the income producing and also increase occupancy levels and positive about the German acquisition also, which is in addition to all what I just said, with buying that business, we also got a lot of new tenants with whom we see opportunity to work with Joe's German companies to help them grow their activity in Europe, for Europe. We see, as I mentioned, European, Asian, but also American companies come to Europe to set up shop here to support their businesses. In Germany, by the way, we also look at doing science and technology park type of projects, as we've done in Brno, beyond the logistics and industrial.
I will now run you through the main financial highlights. Supported by a resilient operational environment, we delivered strong financial performance in Q3. As mentioned before, we achieved strong like-for-like rental growth of 4.3% in the first 3 quarters. This was driven by strong occupier demand, which allowed us to sign leases above their ERV, as well as by its historical low vacancy levels in our markets and indexation on rents. We expect the positive impact of indexation to increase as the leases in our portfolio are adjusted in January. Approximately half of the portfolio is linked to the consumer price index and the other half is with fixed increases. Our net rental income to date increased significantly to 328.2 million, up 36.8% compared to the same period last year. Profit after tax for the same period increased 87.5% year-on-year to 596 million euros. Company-specific adjusted EPRA earnings increased 35.2% year-on-year to 194.3 million euros. The company-specific adjusted EPRA earnings per share increased 18.6% year-on-year to 45 cents per share, on track to reach our guidance of 60 cents per share for the full year. The gross asset value of our portfolio now stands at 11 billion euros, and we continue to grow the size of our portfolio. The year-to-date revaluation of 558 million euros is driven by 183 million related to our developments and 303 million euros of ERV growth. We expect further rental growth to be included in the Q4 revaluation. The portfolio valuation yield as of 30th of June stood at 6.3%, still providing a robust spread versus euro-dominated government bond yield levels. Yields in CEE markets haven't seen as steep declines as in Western European markets, and we expect therefore to see less upward pressure on yields in these markets.
We have a strong and robust balance sheet. Thanks to the refinancing we undertook between 2020 and 2022, during which we made good use of the low interest rates in the bond markets. Our average debt maturity stands at 5.9 years, with only one maturity in the next 2 years, specifically a 400 million euro bond maturing in November 2023. We have a strong liquidity position with 1.15 billion euros available at the end of Q3. And we have a strong relationship with our lenders, as evidenced by the 400 million euro extension that 4 Czech banks gave us in Q3 of 22. Our high unsecured debt ratio allows us, in a time of dislocation in the bond markets, to rely more on bank lending, where spreads are more attractive and funding is more reliable. During the third quarter, we improved our interest coverage ratio to 4.8 times. This is due to the strong growth in the cash flow generation of our investment portfolio. Our loan-to-value ratio ticked up slightly in the third quarter to 45%. This was expected as we have more projects under construction at the end of Q3. We expect this ratio to come down in Q4 and to remain within the 40 to 45% target range that we have. CTP has a strong cash flow generating portfolio with excellent fundamentals and a diverse tenant base. The indexation and reversionary potential of our portfolio will continue to drive like-for-like rental growth, and we see even more potential for that in the years to come. Our industry-leading yield on cost target of at least 10% is supported by strong ongoing tenant demand and decreasing construction costs. We remain on track to deliver approximately 1.3 million square meters of gross lettable area in 2022. We continue to ramp up our solar energy business. This has enormous potential. CTP has a robust capital structure, a disciplined financial policy, and strong, proven credit market access. These strengths position us well to benefit from the current volatile macroeconomic environment, which we also expect will offer significant opportunities over the next months. We confirm our guidance for the full year company-specific adjusted EPRA earnings per share of 60 cents. Thank you for your attention.
Last but not least, very important, just back from New York to do the marathon with a couple of colleagues. We had a great time. More details about that later on. Thank you for your attention.